Capital spending, those are expenditures, outlays that are intended to generate future benefits. So it's typically buying productive long-term assets, land, buildings, equipment, a piece of machine, a new factory, those kinds of items. And the reason we need to look at them separately is that they cannot be taken as an expense at the time of purchase. So you spend $1 million on a piece of equipment, even though you're spending $1 million, you don't get to take it as an expense at that point in time. Accounting rules are used to figure out, okay, how much of this can I take as an expense, and over how long of a period do I need to spread it out, and it gets taken out as depreciation. There's two elements to cash flows from capital spendings in each year. One is the cash flows from making capital investments, so buying equipment, buying factories, and that's generally going to be money that's spent negative. Plus, often we have to incorporate cash flows from selling a capital investment. So what happens if we buy a piece of equipment, or I shouldn't say what happened. What happened is a firm is constantly buying new equipment and getting rid of the old equipment. Take, for example, a factory buys a piece of machinery, and after 3 years, new technology comes out. So they anticipate more efficient equipment. That equipment's going to have a lot of wear and tear. So part of the plan is after 3 years, we're going to get it and replace it. Well, the only reason they had that equipment was because of the project, so they're going to incorporate it. So they'd want to incorporate the cash flows that are associated with selling that equipment. Also, often at the end of the project's done, firm's got a bunch of equipment, factories, they can get rid of it. What cash could they get for that? That's relevant for the project. They had to spend money to get that, so if it has some value at the end, you definitely want to incorporate it. So again, as I talked about before, making capital investments typically negative because you're spending money to buy equipment, buying a building, buying a factory, and typically in this class, not typically in this class, there's not going to be any adjustment for taxes, depreciation. So if a building costs 50,000, a piece of equipment costs 100,000, the investment required is 200,000. That is what the capital investment is going to be, and it typically occurs at the start of the project. In this class, it's going to happen at the start, but in practice, think of a company like FedEx. If they're thinking of they're thinking about expanding into delivery in some remote region, they could have as part of their project a continual upgrade of planes and facilities. So, some help with some language. If you see that there is a project that has an initial investment of X dollars, if it has a project that costs X dollars, an asset costs X dollars, that kind of language means that a capital investment was made at time zero and it was X dollars. Therefore, cash flow from capital spending, negative X at time zero. So just a little bit help with some of the language. Selling capital investment. That's going to involve a positive cash flow, typically, because what happens, we sell equipment and we get money. In this class, it's going to happen at the end of the project. In practice, it can happen at the end of the project too. As I mentioned, the project's going to last for a few years. You're left with some equipment. What are you going to do with it? You can sell it, and money that comes in is relevant for the project because the only reason it's there is because you did because you bought it and had to spend and for the project, so you'd want to take it into account. Suppose we're selling an asset after 2 years, so there's operating cash flow in 2 years, there's the change in net working capital in 2 years. You want to assume that the cash flow from selling the asset takes place after you take that other stuff into account. So don't think, oh, I sold the asset, that other stuff couldn't have happened then because I didn't have my equipment. You operate, you take into account change in net working capital, and then if you're selling equipment, then you figure out, okay, what's the cash flow from that, and incorporate that as well. So what is the expected cash flow from selling a capital investment? Two elements. First, expected price at which the asset's going to be sold for. So if we anticipate in 3 years that we're going to sell a piece of equipment for $50,000, that's a $50,000 check that someone's going to write to our company. We can take that money and we can stick it in the bank. Then we have to do some accounting work to figure out if there are any taxable implications and incorporate the effective taxes paid. So suppose we sell it for 50,000, we do some taxes and realize we got to pay the government 5,000. What's the cash flow? The expected cash flow would be the sales price of the asset, which is the 50 we get in the bank, minus the 5 that we pay to the government. We'd be left with 45. So it's the sales price of the asset, and envision a check coming in, that money's going in the bank. Then you do some accounting, figure out taxes, and that goes off to the government. What are taxes? They are the taxable gain on the sale of an asset times the tax rate. What's the taxable gain? It's just the sales price, how much we sold it for, which is this, minus the book value. How much was it worth on an accounting basis? Well, how much was it worth on an accounting basis? It's the initial price. How much did we originally pay for it? Minus accumulated depreciation, which is the sum of all depreciation that's taken up until the point that it's sold. And if we sell it at the end of 2 years, you include the depreciation from 1 year and from 2 years. So one way to think about it is you walk out and that's how much the equipment's worth. And then you take some depreciation after 1 year. That's how much it's worth after 1 year. Take some more depreciation after 2 years. And so you're depreciating the value on a book basis, on an accounting basis. And the difference between the sales price and what it's worth on an accounting basis is the taxable gain. And as we'll see in examples, it can be 0, negative, or positive.